Every major futures market on the planet is closed right now. Gold is at 5,106, silver is at 83.98, and between now and Sunday night, anything can happen. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, the Fed is frozen, the dollar is at 100, and Iran is still active. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. COMEX closed Saturday, March 14, 2026. Gold last traded at 5,106 per troy ounce. Silver last traded at $83.98 per troy ounce. The US dollar index closed at 99.97. The 10-year Treasury yield closed at 4.245%. The Bureau of Economic Analysis confirmed January PCE inflation at 3.0% this week. That print landed while oil trades above $100 per barrel. 3 data points, all confirmed, all pointing in the same direction. The Fed has no room to cut, the dollar is holding, real yields are positive. Under normal conditions, that combination is bearish for metals, but conditions are not normal. The Iran conflict introduced a risk premium into gold that held even after the pullback from $5,423. Think about what that sequence actually means. Gold spiked to $5,423 after U.S. and Israeli strikes on Iranian infrastructure on February 28th. It pulled back more than 6% to $5,085 on March 3rd. It is sitting at $5,106 today. The floor held. In a rising yield, rising dollar environment. The timing is what deserves scrutiny, not just the price, the timing. Before I show you the full data picture, consider this. The last time the US dollar index sat at 100 while an active military conflict involved a major oil-producing nation. Oil repriced first, then metals followed. That sequence has repeated. The data is already telling you something. Let's build it out. Now let's build the full picture, because the closed market does not exist in a vacuum. The Federal Open Market Committee meets Tuesday, March 18th. The CME FedWatch tool shows near zero probability of a rate cut at that meeting. Zero. The Bureau of Economic Analysis, PCE data at 3.0% is the reason. The U.S. Energy Information Administration confirms oil above $100 per barrel, driven by the Strait of Hormuz disruption. The U.S. Bureau of Labor Statistics PPI data showed a 0.5% month-over-month increase. GDP for Q4 2025 came in at 1.4% annualized. Put those together. Inflation at 3.0%. Growth at 1.4%. Oil above $100. PCE sticky. That is not a standard macro backdrop. That is stagflation. The rate of divergence between growth and inflation is not slowing. It is compressing. The data is doing the talking. The ones who called this a temporary inflation spike, they are not saying much right now. And here is what makes that picture even harder to ignore. COMEX registered silver sits at 103 million ounces. COMEX total open interest represents 429 million ounces notional. That is a coverage ratio of 24%. Registered silver has declined 23.1% in 30 days. That is 23.6 million ounces physically withdrawn from COMEX vaults in 1 month. The Shanghai Gold Exchange is pricing gold at approximately $5,193 USD equivalent, an $87 premium over COMEX spot. The Shanghai Silver Ag T+D contract is pricing at $87 to $89 USD equivalent, a $3.50 to $5 premium over COMEX spot. At the same time, the DXY sits at 99.97. Real yields are positive. The Fed is frozen. That is not a contradiction. That is the setup. And before anyone takes that as a green light, setups can take a long time to resolve. The structural picture and the timing are completely separate questions. Anyone who claims to know the timing is selling something. Now, Iran. Because this is no longer a backdrop, it is the primary variable. Here is the number most people are not walking into this weekend thinking about. Approximately 21 million barrels of oil per day move through the Strait of Hormuz. That is roughly 20% of global daily oil consumption. Through one strait. The U.S. Energy Information Administration confirms that number. U.S. and Israeli strikes hit Iranian infrastructure on February 28th. The Strait of Hormuz situation remains active as of this recording. Oil is above $100 per barrel. The cost math is unavoidable. Every $10 move in oil feeds approximately 0.3 to 0.4% into headline CPI within 60 to 90 days. Oil at $100 sustained for 1 quarter adds roughly 1.2% to annualized inflation. Add that to a PCE already at 3.0%. Markets are still pricing this as a temporary geopolitical shock. Look at the 10-year yield at 4.245% and tell me what probability you put on that. When markets start pricing the reality of what a sustained Strait of Hormuz disruption actually means, gold reprices higher. Oil reprices higher. The dollar reprices in both directions depending on which force dominates. Haven demand or stagflation fear. That is the historical pattern. Every time a major oil supply disruption coincided with a central bank policy trap, it has not been different yet. Gold Western Spot at $5,106. Shanghai Gold Exchange pricing at approximately $5,193 USD equivalent. That is an $87 premium. Silver Western Spot at $83.98. Shanghai Ag T+D at $87 to $89 USD equivalent. That is a $3.50 to $5 premium. Short term, the picture is binary. The Fed meeting Tuesday is the next known catalyst. If Fed Chair Powell signals any language around monitoring conditions or acknowledging growth risk, the dollar sells. Metals gap higher. If Powell is purely hawkish, no pivot language, rates higher for longer, the dollar holds above 100. Metals face renewed pressure. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold or silver does Monday morning. Nobody can. If you think you know, good for you. The COMEX is closed. Globex opens Sunday evening. Bid-ask spreads will be wide. Gap moves of $50 to $150 in gold and $3 to $6 in silver are structurally plausible given the Iran variable. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. DXY at 99.97 with momentum toward 101 creates direct headwind for dollar-denominated metals. The 10-year Treasury yield at 4.245% means the opportunity cost of holding gold and silver remains elevated. A weekend ceasefire announcement would remove the Iran risk premium, potentially gapping gold below $5,000 in thin Sunday night trading. The bull case is equally real. COMEX registered silver at 103 million ounces against 429 million ounces. Open interest is a 24% coverage ratio, and falling. Shanghai is paying $87 to $89 for silver, while COMEX prices $83.98. Physical Eastern demand is not theoretical. PCE at 3.0% with oil above $100 means the inflation trade is not over, and historically gold performs in stagflation even when nominal yields are elevated. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown here today points to one thing. The structural pressure is already built. The Fed is trapped. The Eastern physical market is paying a premium. The COMEX vault clock is running. The only question is when the paper market catches up to what the physical market already knows. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group COMEX warehouse reports at cmegroup.com. U.S. Bureau of Economic Analysis. PCE data at bea.gov. U.S. Energy Information Administration Strait of Hormuz. Data at eia.gov. Logic over hype. Always. If this analysis added value, like this video right now, subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0 out.